Well, we want to welcome you to our call today with Ed Newton, CPA, CFP, and President of Newton Financial Network. The title of today's call is going to be, Don't Enter 2014 on New Year's Day Until You've Heard These 2013 Tax Updates. If you are listening on the phone, and if we have time at the end of the call, we'll open up the lines so Ed can answer any questions that you have. Or if you're listening via the webcast on the Internet, there is a box towards the bottom of the page titled Submit Your Question for the event here. It's got a little green Q&A button there. Just type in your question. If you have one that comes up throughout the call, click on the Submit button, and we'll check those messages again at the end of the call and try and answer those for you. If you are not already a client of Ed's, he's originally from Huntington, West Virginia, has a degree in accounting from Virginia Tech and a master's degree from Liberty University. Ed landed at Arthur Anderson & Company in their tax department and then began his CPA firm in 1977. Ed's a CPA and a certified financial planner and is uniquely positioned to help his clients achieve and sustain a worry-free retirement. Excuse me. And if you do know him, you know that Ed has also been a commercial pilot for a major airline since 1982, and his current weekend routes are to London, England, and Frankfurt, Germany. So, again, good morning, Ed, and welcome to the call.
Well, hello, and thank you, Jeff. I appreciate that introduction. And, yeah, you just made me realize that I'm starting January 1st. I will start my 38th tax season. So,
wow.
Yeah, things have changed just a bit since I started all those years ago. Anyway, I would like to welcome everyone to the call and the webcast today. I did not have a chance to do up any PowerPoints. I apologize for that. I would have liked to put some of those up, but just didn't have. There's so many changes. I'm afraid that would have also dragged the call out longer than anyone would want to listen to it. Up front, let me say that there are a lot of changes for the year 2013 and 2014. A lot of provisions expiring. I want to start by just giving you a brief overview of some of the things that are changing and then get into a little bit more detail. Also, I will say that if we don't answer your questions here, certainly I'll be glad to take those questions offline if it's very detailed, if you will, and would be applicable to your current situation. So we're always happy to do that for clients and non-clients as well. So I'll do that. The other thing I would suggest is that after we finish this call, you ponder it just a bit. And if you feel like that you need to talk with us specifically before the end of the year for your case, something that maybe we're not aware of that's happened for you this year, please give Sarah Beth a call at the office, and she can set up a time for us to either chat on the phone or in person. That being said, let's talk a little bit about the new and tax provisions for the year 2013. I wish I could tell you that they were some good changes, but unfortunately most of them are not. Again, briefly, for individuals, what we're going to find is that the top tax rate has changed. It's gone from 35% up to 39.6%. And as we get into the details, I'll give you the brackets and that sort of thing. But the top rate has moved from 35% to 39.6%. Also, for certain individuals in the upper brackets, we will find that the capital gains rate, which has been quite good for us for the last several years, at 15%, is being moved up to 20% as well. Now, again, that doesn't affect everyone. Most everyone will still get the 15%, but quite a few of you will be in the 20% on your capital gains. Just a tax planning point, if you're going to get rid of some stocks that you want to make some sales of stocks, we should consider doing that before the end of the year if you're either going to generate cash or you just want to have a good profit and you want to get out of a company or mutual fund. We should think about doing that before the end of the year just to save that tax as well. The estate gift and generation skipping tax rate goes from 35% to 40%. So again, when we look at gift taxes that are taxable, anything over $13,000, actually in 13 it hits $14,000, I believe. And have to do a gift tax return, the top rate goes from 35 to 40% again. We used to have, and I'm not sure that most people even realize this, but back before 2009, it was possible that you would lose some of your personal exemption or even your itemized deductions if your income were too high. Then in 2009, those provisions actually expired, and for the last 4 years or so, there have been no limitations on the personal exemptions or the itemized deductions. For 2013, those phase-outs and reduction come back in. Again, we'll talk about that in some detail in a few minutes. For those of you that either already have a home office or we have discussed doing a home office deduction for you, they did put a safe harbor provision in for the year 2013. It's not the greatest thing, but at least it does allow us to use certain numbers and certain square footage, etc., and the IRS will not question those amounts. Now, you still have to show that you meet all of the other requirements for a home office deduction, but the amounts that we would use are provided by the IRS. I'm not going to touch on this too much, but there is a new definition of married for federal tax purposes, and that has to do with the same-sex marriages that some of the states now allow. One that I really do want to touch on for a couple of minutes, I'm going to talk about it now, and then when I finish the brief update, I will give you more information on that. But it's the filing of what's called the FBAR. FBAR is the acronym for that. And that is a Treasury regulation. Actually, it's a report of foreign bank and financial accounts. The IRS and the Treasury Department have really cracked down on this, and the penalties for noncompliance are extensive. So if you have any sort of financial accounts or signature authority over any accounts in a foreign country, that's definitely something we should talk about, because that is a major provision of the law. For businesses, they come up now with these capitalization regulations. In the past, we've been able to say, okay, any capital item that we might add that is $350 or less, we won't capitalize it and depreciate it, we'll just expense it in the year. Well, the IRS has issued regulations, final regulations on that, and made it much more difficult for that type of thing. So again, I certainly don't want to get into a lot of detail on that and bore you to death. That is part of our job, is to handle that for you. But I just wanted to let you know that there is that as well. There is permanent indexing of the alternative minimum tax threshold. We'll speak about that in just a little bit. Medical expenses, again, we don't have many clients that are able to get a medical expense deduction due to the floor that's been in place, and that floor has actually now been raised. Instead of 7.5% of your adjusted gross income, it's now 10% unless you're over 65. Two things I think that will hit many of you this year is the the new tax on wages and self-employment income of 0.9% over the threshold. And again, we'll talk about that. But that is an additional tax to pay for Obamacare. Also, there is a net investment income tax of 3.8% that also over a threshold amount, and those taxes will pay for the Affordable Care Act as well, or as it's commonly called now, Obamacare. A few things that expire after 2013 that do have ramifications for you for this year is the exclusion of $2 million on discharge of qualified personal residence indebtedness. In other words, if you're upside down in your mortgage, you either had to refinance the mortgage and the bank forgave part of it. That limitation is now $2 million. Again, I don't think that affects any of our clients, but certainly there could be someone on the call that does affect. That goes away January 1st, 2014. Another very small one for teachers, the $250 educator allowance that you can take above the line has disappeared. And the same thing for sales tax for our clients in Florida, Texas, and other states that do not have an income tax. We have been able to take a sales tax deduction for you, and that expires in 2014 as well. So that will have an effect on you. And the higher education expense deduction also expires. So those of you that have been able to take a deduction for expenses, for education expenses for some of your kids, that is going to expire. Two things that really hit business, could potentially hit businesses very hard, is something that you need to think about if you do own a business. And that is the 50% bonus depreciation deduction goes away in 2014. And basically what that does is that allows you to write off half of the capitalized item in the first year. That goes away in 2014. And the bigger one is what we call the Section 179. And that is the provision, the overall provision, that does allow us to take a capitalized asset and write it off during the year. In the year of acquisition, write the entire thing off. We've had a $500,000 limit on that. So if you bought a $75,000 piece of equipment for your business that was used 100% in business, you could write that entire $75,000 off in 1 year. In 2014, it drops all the way back to the original amount, which was $25,000. So bottom line is, if you're in a business, if you look like that you, if it appears that you do need to buy some equipment, the first quarter even of 2014 that's in excess of $25,000, we should talk about that and very possibly go ahead and buy that this month and place it in service so that we can get that extra tax benefit. That pretty much covers everything that, from a general standpoint, that I want to cover. Before I get into talking about some of the details of these provisions, I would like to go back to the F-bar for a minute and just try to hit on that and give you a little bit of information. If you have any foreign account, like I said, that you have any funds in, that has to be reported to the federal government. And that is something that the Treasury Department is really focusing on and is making one of their top priorities. The penalty for not filing that is up to $10,000, and I don't remember seeing that, but I believe there's also a criminal penalty that goes with that as well. Now, I don't expect them to be levying those types of penalties on everyone that has, a little bit of money in a foreign account, but the fact is we do have to report that, and that's something that I would really strongly encourage you, that if you have any foreign accounts at all, that you get together with us and let us start working on that and get you compliant with that, because that is something that the Treasury Department and the IRS are really stressing and working on this year. And that also extends to if you have signature authority over an account. We have several clients that are English, British I should say maybe, and I know that some of them, and we've certainly worked with them on the FBAR, the ones that we know about, but potentially let's just say that you are a British subject, you're living in the U.S. now, and you still have, there's a bank account back in England that has your mother's name on it, and you have signature authority as well. That needs to be reported to the U.S. Treasury Department. So again, if you've got any sort of financial connection to a a foreign account, we need to talk about that. To get into a little more detail, I want to speak a little bit about the provisions expiring in 2013, the new provisions for 2013, as well as the Affordable Care Act. And I'll say right now, and I try to say this every time that I speak with you about tax or even investment issues, nothing that I say will have a political bent to it all. Also, as I call it Obamacare, I don't mean that derisively, although I know a lot of times it's said that way, but it's just much easier to say Obamacare than the Affordable Care Act every time. So if that does bother you, I apologize. I don't mean anything by it. Most people think that has to do with health care. Trust me, it has a lot to do with taxes. And I've spent quite a bit of time in the last 3 months attending seminars and conferences that talk about the tax implications of the Affordable Care Act as well. Again, let's talk a little bit about in more detail about the expiring provisions. The 3 main ones that are expiring: the $2 million exclusion of the personal residence indebtedness. Again, to give you a brief overview, if you did a short sale on your house, or if you just gave a deed in lieu of foreclosure, had your house foreclosed on, anything like that, that amount of indebtedness that you had that was forgiven is taxable without this provision, and that provision is expiring. So in 2014, if you go through this unfortunate event, whatever debt was forgiven will be taxable income for you. So that's one thing to be aware of. Secondly, the $250 above-the-line deduction for teachers. I know that's not a lot of money, but let's be realistic about it. If a teacher spends $250 of their own pocket money, and most of them spend a lot more than that, but if you spend $250 for items for your classroom, in the past you've been able to deduct that on the first page of the return, which has no limitations or whatever. So they're taking that away. It's possible that some of these provisions may be put back in 2014, but we won't know until late 2014. Also, the sales tax deduction is going away in 2014. Again, that would apply, I'm going to say 99.9% of the time, only to folks living in no income tax states. Almost always the income tax that you pay to the state is higher than what you would get on the sales tax deduction, and the law does specify that it's the higher of the two that you can take. And then the other thing is the itemized deduction for the qualified higher education expenses. That is also expiring. For businesses, again, we talked about the Section 179 goes all the way from $500,000 to $25,000. So again, if you're looking at buying a large piece of equipment for your business, you should definitely consider doing it before the end of the year. Another one that I didn't mention, and I'll just briefly talk on, is the health coverage tax credit. That also disappears in 2014. We get questions quite often from clients talking about the filing requirements. Well, I only made X number of dollars. Do I really have to file a tax return? And those have changed. Those have gone up a little bit. Just to give you those numbers very quickly, a single person, for example, if you make over $10,000, you have to file a tax return. Married filing jointly, it's $20,000. So again, this is definitely low-income people, lower-income people that we're talking about, but also it does come into play for your children. That's probably where we get the biggest phone calls and discussions about is whether the children have to file a tax return. And that has also changed slightly. For the children, the filing requirements for dependents has gone from $950 or investment income, or salaried income plus $300. So now it's the larger of $1,000 or earned income up to $5,750 plus $350 of other income. So basically, if your child worked part-time, if they made less than $5,750 and have less than $300 of investment income or other types of income, they do not have to file a return. The personal exemption phase-out that I mentioned at the top of the call, that one, again, for a single person, you start to lose part of your $3,900 personal exemption, whether it be for you, your spouse, your children. This will come into play for all of them. For single, it begins at $250,000. And for a married couple filing jointly, it begins at $300,000. I'm going to speak a little bit about the marriage penalty in a couple of minutes, but here you can see one place where the marriage penalty comes into play, and that is if two folks were single, they would each get to keep their exemption up to $250,000 of income, but if you're married, you start losing it at a combined amount of $300,000. Same is true for the standard deduction. We don't have many clients that do take a standard deduction, but that has grown a little bit this year from 2012 to 2013. For single individuals, it's up to $6,100, and for married filing jointly, it's $12,200. So in that case, there is not a marriage penalty per se for that. The itemized deduction limitation, the phase out of that, is computed differently, but it's pretty much the same as it is for the personal exemption. And that is, if you're single, you begin to lose your itemized deductions if you make over $250,000, and you begin to lose your itemized deductions over $300,000 for a married person filing jointly. The income tax rates have been indexed for inflation for several years now. Those have changed a little bit. I won't bore you with all the numbers. They're up just a little bit, but just to give you an idea, for taxable income, you go to the 28% bracket with $146,400 of taxable income, married filing jointly, and you hit the new 39.6% at $450,000. For individuals, that 39.6% does not kick in until $400,000. So again, married filing jointly, it kicks in at $450,000. Single, it kicks in at $400,000. So again, we talked about the marriage penalty there. I've told you briefly about the medical deduction. I'm not going to spend any more time on that, but it does go to a 10% floor of your adjusted gross income over the 7.5% that it is now. Again, talking about the capital gains rates that they have gone up. In 2013, once your income for a single person is $400,001, you will start paying 20% instead of 15%. And for a married couple filing jointly, it's at $450,001. So again, we see some of the marriage penalty there. As we talk about the marriage penalty, let me just talk a little bit in generality. Not that anybody's going to really do this, but the marriage penalty starts from the marginal tax rate at about the 25% rate, which for a single person is $87,850. For married filing jointly, it's $146,400 is the top of the 25%. And in the middle of that 25% bracket is where the marriage penalty really starts, and by that I mean that two people married, filing jointly, pay a higher tax rate on the same amount of money than a person that's single would pay, or two single individuals, would pay on that. So the answer to that is get a divorce. Just kidding. Hope you realize I'm just kidding about that. But it does come into play as far as that marriage penalty. It does cost you additional money, and you get in the higher tax bracket much quicker. They have worked on getting rid of that, but at this point it still exists in many areas. And it exists in the new Medicare tax. This is one that's going to hit many people this year. There is a 0.9% tax on your Medicare earnings in excess of $200,000 for a single or head of household person, $250,000 for a married filing joint. Now, your Medicare earnings are not limited like your Social Security. We talk about the Social Security tax being only on the first $113,000. Medicare tax is unlimited. So if a person makes $800,000 in salary, you pay Medicare tax on that entire $800,000. And in this case, now with the additional Medicare tax, that is 0.9% more. So you're going to pay that on all of your income and self-employment income as well. That begins in the year 2013. And that there's a new form for that. Of course, we'll take care of that for our clients when we do the tax return. The next one that will hit many of you is the 3.8% Medicare tax investment income, or I should say Medicare tax on investment income. And investment income is defined as interest, dividends, annuities, royalties, rents, some rents, substitute interest payments, and substitute dividend payment. Excuse me. Then any other gross income that you might have from a trade or business that's passive income, where you're just an investor but not actually involved in the business itself. So this 3.8% tax is in addition to every other tax we have, and in fact, some folks are calling it the third level of taxation that we have, the first of income taxation. The first level is your regular income tax. The second level is alternative minimum tax, and then this third level is the Medicare tax, the 3.8% Medicare tax on investment income. The thresholds for this are the same as for the 0.9% Medicare tax on salaries, but this one is the 3.8%, which is significant, and those thresholds are $250,000 for married filing joint, $200,000 for everyone else, and that's effective this year. To give you an idea of how high the marginal rate can easily be, for a client making $450,000 or more, you could very easily be not in a 39.3%, but all the way up to a 45.5% tax bracket, and that's just federal. You put your state on top of that, and you can see that your effective tax rate can easily be above 50%. The alternative minimum tax, as I said earlier, they did make that permanent, and they've indexed that for inflation. But just to give you an idea of how, for lack of a better term, how low of an income you might have and still be subject to the alternative minimum tax, the exemption for alternative minimum tax for a married couple filing jointly is $80,800. So if you have more than $80,800 of taxable income, you may be subject to alternative minimum tax. And that alternative minimum tax is 26% on income up to $179,500 and is up to 28% on everything above that. I know this is a lot of numbers, and believe me, I can tell from my throat this is very dry, and I realize it's very dry, but I think it's also very important to cover some of these in detail so that if nothing else, it might raise some questions in your mind as to whether it affects you, and maybe there's something that can be done to help to alleviate that. The capitalization regulations for business, again, I certainly don't want to get into detail about that. You talk about dry. That is dry reading. But basically, the final regulations have been put out, and that means that we do have to abide by those as they are the final regulations. And there is a slight de minimis rule, but again, if you own a business and you're listening to this call and you have any plans in your business to do any sort of additional purchases of fixed assets type things, I definitely think it would be wise to talk with us very soon. The home office safe harbor, again, this is a revenue procedure. It begins in 2013, and basically what it allows you to do is to say, if you can show that you do have a area in your home that allows you to work exclusively in your business, then they say, okay, we will let you, without having to show us your utilities and your interest and your taxes and all that, you can take $5 per square foot on the up to 300 square feet in the house. So that's $1,500. So it is nice to have that safe harbor, and it may cause me to discuss with some clients the idea of actually taking it this year, where in the past I've recommended that we not take that. Other provisions in the taxes, there is a cap now on your flexible spending account is $2,500, and that's for everyone with a flexible spending account through your employer or whatever. I do want to spend a little bit of just a few minutes with the Affordable Care Act. I know we're coming up on 35 minutes, and this is certainly one of the longer webinars we've had, but again, I do think it's important to discuss some of this. So as far as taxes go for the Affordable Care Act, some people are saying, okay, if I do have to pay this penalty for the year 2014, it's only $95 per adult. I'm not going to worry about it. The family cap is $285. I'm not going to worry about it. What is not being publicized is that the other side of that is 1% of your income. So again, just take somebody that's thinking along the lines of these insurance and paying the penalty instead of having the insurance. 1% of $400,000 would be a $4,000 penalty. So, and again, I don't think it probably affects many of you this year, because most of our clients have employer-sponsored health plans, and so that would not affect you. Although if you are in business for yourself and you do have your own medical plan, then it definitely would affect you this year. So again, it is quite complex and complicated, so I really don't want to get into that in too much detail. But if you do have questions on that, I'm certainly willing to discuss that with you as well. Well, Jeff, I think that's about all I can talk right now. My throat's about had it, and I know this has been very dry and very boring to all of you, but hopefully it will pique your interest, and if there's anything at all that we need to discuss, we'll be happy to do that. So, Jeff, I'll turn it back over to you.
Okay, Ed. We've got several people on the line. I do have a question that came through the Internet. If you're on the phone and you have a question, you're welcome to go ahead and ask that. I've opened up the lines. Just go ahead and speak, and we'll kind of hear if anybody has a question.
Yeah, hi. Yeah, hi, Ed. This is Bill Love. How are you?
Hey, good, Bill. How are you?
Not too bad, thanks. I had a couple of questions, and I don't want to monopolize the time, but you talked about the foreign assets. As you know, my wife's Canadian, and she has retirement funds up there that she had before we were even married, and we report that every year. But I'm just curious as to why you're emphasizing it this year. Is there something nefarious we need to be worrying about that the government's going to try to tax, or?
No, the reason I'm doing it this year, Bill, is because I know there are a lot of folks out there that have not reported that. And it's not that they're being nefarious or trying to cheat the taxes, because it, like you said, as a retirement plan, it's not taxable. But the fact that the IRS and the Treasury Department has made this one of their top priorities to find these, and the penalties are so large, that's why I'm emphasizing it. And like I said, I know there are a lot of folks out there, folks like you guys that do have a Canadian retirement plan. I know some folks that have, as I said, the checking account with their mom in England. That still needs to be reported. If you don't report it, you are subject to that $10,000 fine. So it's a pretty big deal.
Okay, so let me ask you this then. We've got some savings accounts for our children that are in our children's name, but we have signing rights, like you mentioned, on it, and that was for their education. That has to be reported as well?
Yes, it does.
Okay.
If you have signature authority over it, or if you have the authority to direct those funds, then yes, that needs to be reported as well.
Wow.
Now, it doesn't necessarily mean it's taxable, but it just has to be reported that those funds are in an account. So based on your wow, I think we probably ought to talk about that offline.
Yeah. I mean, it's just the fact of the only reason I say wow is like, not to try to get political, but I don't think it's the federal government's any damn business. Sorry.
Okay.
I'll stop opining.
Okay.
The second thing is about the home office. We do run a home office here. I'm actually working in it now. So is there anything that changes for that? Or because I know you mentioned it, and we have claimed that from year to year.
Right.
Is there anything that has changed, or is it better? Did I hear that right from you?
The only way it's changed or better, Bill, is that now there is the safe harbor. We don't have to say, okay, how much is the mortgage interest, or folks that rent, how much is the rent, how much is the utilities, and document all that. We can say, okay, we're taking $5 a square foot for the amount of space that you have, and that's our deduction.
Awesome. Okay, cool.
Okay?
I'm going to shut up now.
Okay. Thanks, Bill. Appreciate the call. Appreciate the question.
Ed, we do have a couple of comments and a question come through the webcast. One, somebody from Charlotte is asking, Ed, does a person who has no wages but receives Social Security retirement benefits and a pension totaling over $12,000 still need to file a return?
Well, I almost covered that, and I decided that I was going to skip over that for brevity of time, but I'm glad you raised the question. If you have only Social Security benefits and that are not taxable, and if you don't have any other income, your Social Security benefits are not taxable, then you don't need to file a tax return. The kicker that you just put in your question is also a very good one, and that is if you have taxable pension benefits greater than $12,000 plus Social Security, then yes, you would have to file because of the pension benefits being greater than $12,000. However, you may or may not be taxed at that point on the Social Security. So if you have non-taxable income, again, specifically your Social Security, if that's your only income, or if that's your only income plus other income less than $12,000, you don't need to file. But if your pension benefits are greater than 12, you would need to file.
Gotcha. That makes sense. I'll forward this question to you just in case you want to follow up with them.
Okay.
Another comment. This is just a comment. Seems we middle Americans need to quit our jobs, put our cash in a hole, and go on food stamps and get a divorce.
Ooh, I can think of
I like the way that guy
my
talks.
clients that might have brought that comment forward. You know, it is. It's tough. But even as I mentioned before, with the top rate certainly approaching, if not exceeding 50%, we're still with much lower tax rate than we were in the pre-Reagan days when it was up at 70% at the top rate. So, you know, I certainly agree, and unfortunately these kind of calls always seem to be, for lack of a better term, depressing, and I certainly don't mean it to be, but I think that's about all I can say on that.
The phone lines are still open. If you have a question, just go ahead and speak up. I think that's it, Ed, in terms of questions coming through the webcast.
Okay.
And how about this? If somebody's listening on the replay, we'll obviously post this on the website and on YouTube. If they have a particular question, what's the best way to get a hold of you and ask that question?
You can either email me directly at ed@ednewtoncpa.com, or give us a call at 704-552-8689.
Super. That's great. Well, Ed, I think that's it in terms of questions. Any other wrap-up information or final summary other than the last comment we got on the Internet about what folks should do?
The only other thing would be, again, if you're a client or a non-client, we'd be happy to speak with you about any of this that we have touched on or anything else that you have. You know, be happy to talk with you either in person or on the phone, and just give Sarah Beth a call and she can set up a time.
Great. Well, Ed, thanks again for taking time out of your schedule to cover this information. We appreciate everybody being on the call. And again, if you have a question for Ed, just send him an email, or the phone number again, 704-552-8689. So I think that's it. Ed, thanks again, and we'll talk to you soon.
Okay, thank you, Jeff. Bye-bye. Bye, everyone.